Okay. So guys, what I want you all to do tonight is to have your charts up. There's some things I want to share with you guys. You guys have been asking a good bit about scalping or intraday trading on the lower time frames. And scalping gets a bad rap. It is a viable way. It is not gambling, blah blah blah. It is just a different way to look at the market. Plenty of people do it. Plenty of people make a great living doing it. And so many of you have been asking about that. So we want to kind of delve into it and using the same system, same setup. But what we're going to do, we're going to truncate or reduce the time frames that we're looking at. Okay. So what I want to do, I want to show you what we have, and then I want to show you how we can use this to our advantage. Okay. Give me 1 second. Let me get it set up here. Now, you all know the regular setup that we normally use, meaning that the orange arrow is for the 4-hour. The orange arrow is for the 4-hour. The white arrow is for the daily. Okay. And so the whole premise of it is we use higher time frame rejection to determine the bias to where the trend is going. Once we make that determination, we simply jump in with the highest probability, knowing that the more time frames we have pushing in a particular direction, the higher our probability is that we will win that trade. Okay, so that's the whole premise of what we do. Okay, so I'm going to jump right to the nitty gritty, guys. So if somebody wants to type anything for any note taking, you can do that. But I just kind of want to kind of give it to y'all raw. Okay. So let me zoom in here. As we know, Simplicity gives pretty decent entries, right? On the 5-minute. However, all 5-minute arrows are not treated the same way that all 15 minutes are not the same way that all 30 minutes, 1 hour, so forth are not the same. What is the determinant factor between what makes one arrow more valid or not or stronger is what just rejected, what price just rejected off of. Okay. So as we can see right here, we see a yellow, we see a pink, and we see a light blue. Okay. All right. Now, this is my indicator pivot lower. Okay. It has some tweaks. It is not exactly like the pivot ones that you all have. I've made some tweaks to it so it'd be a little more accurate. Okay. But as you can see, the owl, this yellow, and so I want you to pull up your standard setup. And then what we want to do, we want to start modifying these arrows. Okay. All right. Is everybody with me? Let me pull up the chat, see if anybody has it. Okay. All right, cool. So y'all with me. So what I want you to do, we're gonna have three. We're gonna have 3 arrows, okay? Because we're on lower time frame, that could be a little jittery, so we need a little extra confirmation than we would 15-minute 4 daily, okay? All right. So the first one, I'm sorry. I want to start with the 1 hour, okay? So if you want to like click on your 4-hour arrow that's normally orange, just double click on that. Okay. We want to go to, now this is not much different, but you want to go to input. You want to change your time frame. You want to change it to H1. Okay. Change that to H1. Then over in the color section, we want to change all those arrows to yellow, arrows and the lines. Okay. H1. For our color convention, we're going yellow. Okay. Now this is a little bit different because this is my indicator as opposed to what you all see. Okay. We want to choose yellow. the hour is going to be our primary time frame that we're basing major trend off of, okay? So this is going to be like the big kahuna that daily was. Okay, everybody with me? Okay. So next we're gonna click on what would be the daily. Okay. We're gonna change that to 30-minute. Okay, so do M30 or 30-minute, whatever is listed in there. Choose 30-minute. Okay. What we want to do, we want to change all pertinent colors to pink, hot pink, whatever family. We want things to be very distinct so we know what we're looking at. Okay. Pink, hot pink, what have you. Okay. Is everybody with me? Anybody not with me, say, hold up. All right. And so we're going to make, gotcha, Tiffany. All right. So you don't have to, you can pull up your standard simplicity setup like we have template and then just start modifying. Okay. Now what we're going to do at the end of this, we're going to resave it under another template name. Okay. But doing this will not impact your current template. I don't want you to have to start from scratch. So yellow stands for what? Pop quiz. Yellow stands for 1 hour. Okay. If we need to do it, we'll have replay of this, and Tiffany, I'll get with you. Okay. You're welcome. The pink or hot pink is the 30-minute. Okay. Hey, hey Yoshi, all you have to do is load the same indicator on multiple times. Okay. Yes, load the indicator on multiple times, and that'll allow you to manipulate and to create different time frame, different time frame focus. Okay. So we'll, in essence, you'll load this on 3 times, and then you'll modify them differently. Okay. So 1 hour is yellow, 30-minute is pink, the light blue one, and everybody will probably have to add a third one on. Okay. So we will click on that. All right. I've got powder blue, but you could choose something in the blue family. And this is going to be the 15-minute. Okay. 15-minute. And you could choose powder blue, baby blue, Carolina blue, what have you. Okay. So as you can see, when you zoom out, you can see 30-minute, it's hot pink, the blue, and you see the yellow. Okay. So what we developed, we have pushed down our time frame reference to something that is most closely related to the time frame we want to trade from. Okay. Reason being, this strategy is about taking the trade on the 5-minute time frame. Okay. And you don't have to be scared of the time. People are scared of the 5-minute because they don't know when to get in and when to take advantage of. But guess what? Every long term or long time frame trend starts at the 1 minute and 5 minute. So the quicker you can catch it, the shorter your stop loss, the larger your profit, okay? But all of them are not created equal. You need them leaving crucial spaces like this. You see this? This bounced off to 1 hour, okay? Now, it also bounced off, it's covered up right here, but it's the 30 minute as well. And we can see this exponential move here because we got a 5 minute entry based off of 1 hour rejection. Okay, that's the same as taking a 15 minute entry off 4 hour and daily. Okay, y'all see how we're starting to develop our A, our B, and our C setups. Excuse me, guys. Y'all see how now with that same convention of A setup, B setup, C setup, we now can compress it down to shorter time frames and see the same quality setups. Okay, does that make sense, guys? Give me a 5 if that makes sense. I don't see any numbers yet. Does not make sense. Okay, here comes a 5. All right. So just to plainly, and I want y'all to, and we started with the 415, okay? Then we expanded out to the 415 daily, right? But regardless as to time frame, that is irrelevant to this conversation. The whole point of it is we take entry off the rejection of strong confirmed higher time frame. Okay, so if it works for the fifth, if we could take 15 entry based on 4 hour and hour, 4 hour and hour bias. Okay, we also can take a 5 minute entry off 15 minute, 30 and hour bias. Okay, so I want y'all to expand your thinking and don't just say it's got to be on the 15 minutes, got to be what is the 4 doing? Because the 5 minute is so far from the 4 hour, they're not relational. I mean, it can to a degree, but I mean, it takes 25 minute candles to make 1 hour candle, right? So you multiply that times 4, it would take 85 minute candles to fill up a 4 hour candle. That's too much space. There's too many things that can happen in between there. But it takes three 5 minute candles to make a 15. It takes 6 5 minute candles to make a 30. It takes 12 12 5 minute candles. Yeah, 12 5 minute candles to make an hour. Okay, so now we're talking about more relationship in time together. Therefore, they have more impact on what that time frame does. Okay, so that's the only thing we're doing, guys. We're just moving time frames down to something that's more related to it, so that we can get more accurate entry. Okay, that makes sense. Give me a 7. Right. Don't want to lose anybody. Don't want anybody to fall off. Okay, great. So let's look here. We saw that one. This one is beautiful here. Look at this, guys. Hold on, let me turn off the auto scroll. Sorry about that. Look at this, beautiful. Look at this beautiful drop here, guys. So let's say we get a simplicity entry. Okay, we get a simplicity entry right here. All right. When this comes in, we have to look at what happened just prior. What do we see? We see the 30 minute, we see the 15 minute rejection. Okay. We see it bounce off to 15, but the 30-minute is still prevailing, right? But what do we see right above us? Somebody tell me what we see in addition to that. Just look above. Yes. We see the 1 hour. I don't see the arrows per se, but as long as hold on, let me scoot back. I don't see the arrow right here, but I can see this yellow line, meaning that the hour is still in control from a bearish perspective. Okay. So as a result, I can consider this a 1 hour, 30-minute, and 15-minute push to the downside. Okay. If you think that the 15-minute is a little too noisy, please get rid of it. Okay. If that's going to make you question the trade, if you just want to keep the 30 and that's perfectly fine. Okay. Just want to give a little more context. Okay. So when we see this and this and this match up, and let me pull up. Well, it didn't work. But anyway, once we see this came in, all these things lined up, we're just going old school. Well, no oscillator or anything right now. I don't know what's going on with that. This becomes our entry. Okay. The level that was just rejected right here, or if you want to do the simplicity level, can be your place of stop. That's 11 pips. Let's say you want to take it. You know what? Say, Tony, I feel comfortable above the 30. Okay, that's 20 pips. That's a 20 pip stop. All right. Look at the length that this thing goes. This is your 1-to-1 right here. Okay, it took you on a little bit of ride, but taking it all the way down here, this is a 3-to-1 trade. Okay, so it's the same level of entry. We look for all the same areas of confluence. We look for the moving average to cross. We do all those things, but we just look for different kinds of tea leaves to read in order to give us clearance to get in. Okay. I did current. That's cleaner. I'm sorry about that, guys. Okay. So that's all it is. So, I mean, let's go to another pair. All right. All right here. This is not ready. We don't see confluence, right? We do not see confluence. What do we see? We see the hour, but we also see the 15 and the 30-minute being poised to push back. Now, it looks like the hour may keep pushing up. We don't know, but we don't have confluence here, so we're going to stay out of that. All right. We see like this may have crossed, but this may get into some sideways action. Okay. So when you read these things, you know when to get in, you know when to stay out. Okay. Hold on 1 second. Let me unlock this. Okay. Now, when you're scalping, you don't have to stay in for the whole duration, guys. You can go for a set number of pips that you're after. Okay. What do we see right here? We see the hour, we see the 30-minute, we see the 15-minute, we see the arrow, we see a cross. All right. When we see a cross, we can feel comfortable enough to get in. What are the levels we can put as a stop? We can put it right above the cross. We can put it above the level of structure that simplicity gives. Or we can put it above that level, whatever your level of comfortability is, okay? All right, or you could wait till this retest right here is over. If you feel it's too far from the moving average, you can wait till this retest and then you can enter here, okay? But as you can see, even if you put it above here, it never came back here, okay? Let me measure this to see how far this is. Y'all forgive me for this thing being slow. We're looking at, let's just round it up, say 20 pips or 35 pips, okay? But as you can see, you got your 40 pips in pretty quick order, okay? And so what we want you to do is when you get a simplicity arrow, just make a decision. Is this an A setup that I want? Is this an A? Is this a B? Is this a C setup? Okay. Let me look back here. This was some consolidation, right? But of course, we're not worried about this, all this back and forth. This right here, excuse me. This right here is pretty much your place of optimum entry right there, okay? But we know from this pink, we know from this blue, and we know, and we should be able to see, let me scrunch this down a little bit. You see that yellow? Yellow, pink, blue. We know when it gets out of consolidation, it's gonna go, and it's gonna go really hard. When it did, that went 80 pips. If you would have put it under this level, you would have about a 12, let's just round it up, say 15 pip stop, just to be safe. 15 pip stop, 80 pip take profit, guys. Okay. That's about a 4.5 to 1. Okay. But you have to be patient and wait for these setups to mature. We don't jump in right here. This is consolidation, right? But we wait for our moment. Wait for our moment. When the moment comes, boom, we get in, we strike. Okay. Right here, the hour started over. Hour. If you want to get in just based off the hour, you can. Okay. That's the stronger time frame. This is your entry right there. This would be your stop right above. It paid you. Okay. This allows you to get in and know how many pips you want to go for, guys, and just get into the market. But this is the safest entry. We're just not taking any one. Now, if you had gotten this one, would it have paid you to a degree? Yeah, it would have paid you. But we need to look to see what is pushing where we want to go. Okay. Let's look at something. Let's look at another instrument that you all might like to scalp. Okay, let's look at I don't know where my NAS 100 is. Hold on one second. Oh, forgive me. Let's look at NAS 100. That's a popular pair that people like to scalp. Okay. Oh man, look at this, y'all. I think this happened today. Okay. We had simplicity arrow came in. Just 5 minutes. Okay. Technically, this is where we had the crossing here. Could have gotten in right here. Put your stop either right there. Put on your level of comfortability. There's a green level right here that's kind of in the mix. You could put it a little bit above there, or you could put it above there. Okay, it's your level. So your but we see that the hour and the 15-minute, and I don't know if it's a pink one back there. It's that they're all stacked. So y'all forgive me. I can't make out whether it's a pink one back there. But we at least know the hour is going that way and the 15 minutes going that way. Okay. This can be your entry, guys. It never came back. It tempted it a little bit. If you just want to get that little, now with NASDAQ, you may say, well, that doesn't look like much. That right there is 38 pips. Okay, depending on your lot size, with NASDAQ, that will pay plenty. Okay, we say, you know what? I'm not gonna play with this. Not gonna play with this. Okay, well, fine. We can wait until things line up right here. Okay, we can wait till things line up right here at the crossing. At the crossing moving average, or we want to wait till everything lines up. I personally would take it at this crossing. That's the most optimum entry. You put it above this level, you got a 52 pip stop. That sounds bad, but look how far it went, y'all. I'll just take it down to this rejection right here. That's 252 pips. You put a 1 cent lot in, that's $1 a pip. That's 250. Okay, you risked 50 to make 250. That's a 5-to-1 right there. Okay, and we have never had to leave the 5-minute. Okay, so this would be a great re-entry once you see it came out and it came back into alignment. Okay, and so that works for that. Let's look at gold. I know people like to trade, and it's going to make sense in a minute, guys, why I am looking at smaller time frames. Okay, because we're going to talk about something else just before we leave. Right here, we see the hour, we see the 30-minute, we see the 15-minute, we see the arrow come in. Okay, technically, we're not getting in until right here. Okay, that gave you some. Okay, this is a quick hit. All right, it's 20 pips. 20 pips on gold, given the right size, will pay you handsomely. Okay, so of course the 15-minute, but the real move was right here. Okay, this is the reason I like to use the oscillator with it, because let me pull the oscillator up, guys. So I can see right here, it wasn't a lot of volume here. So while you can have all the great setups all you want, if there's not volume here, guys, it won't support it. But as you look here, when the volume came in the market, now we had an exponential drop. Okay, so we're talking about a 20 pip stop. If you want to put above that level, 37 pip stop, but it ran 100 pips down to this point. We want to take it down to the bottom of the box, ran pretty much 120 pips. Okay, so this is what we're talking about when we just let the market tell us what we want to know. We only use the simplicity arrow as a warning signal. Hey, come look at this. Hey, come inspect this. You may be interested in this. And then we see what preceded the simplicity arrow. And then we wait for our setup to happen. Okay, we wait for our setup to happen, and we're patient. Look at this. We wouldn't have gotten in right here, even though this was all green. Look at this, guys. And this is what I mean. Just because you see the trend surfer, and I brought the trend surfer up just so we can see it relationally. Just because the trend surfer is up and green, normally we would get in there, but why go through all this turmoil when we can wait for bullish momentum to be there through the oscillator? Okay, and we don't have to worry about all that. It's an extra level of filter. Okay, so this plus this breaking at the same time, now we get exponential move. Okay, All right. So what moving average are you using on the lower time frame? The moving average, I think everything is scaled to, let me look on the time frame here. Now, so far as simplicity is concerned, I think it's at a 12 as opposed to a 13, just a little faster. And this is just a 50. Okay. This is just a 50. So I've sped it up a little bit by 12. It's probably really negligible. It's late, guy. So let's change 13 just to see what it said. Now you may say, well, Tony, what if I lower the trend period to 7? It may get you in earlier. It may tell you to get in earlier, but you won't have the safety of all the confluences. Okay. We're about the easiest pips, not the earliest pips. Okay. Any other questions pertaining to this? Because I'm going to move on to the next thing that piggybacks off of this. Any questions, guys? Does this make sense? Give me a 9 if this makes sense. If it's something that you can use. 999. Okay, does that resonate? Seem like something you could use? You all know what we look for now. Now I'm trying to expand your thinking on how to apply it in different ways. This works with a weekly, daily if you want it to. This works with the 5-minute, 1 minute if you want it to. 15-minute, hour. It's the concept. I don't want you guys to get locked into a time frame. I want you to extrapolate the concept of multi-time frame trading. Okay, it works no matter the setup. Okay, so I'm gonna stop sharing that because I want to just talk a little bit about. God, guys, it's something in here flying around. I'm sorry. I want to talk to you guys about how we want to trade and how we want to risk our money. I've seen people have loads of success, and last week was a weird week. I didn't trade a whole lot. It was a weird week. Because like we talked about, it was end of the quarter, end of the month, end of the fiscal year. Weird stuff happens. And so it's okay. Not trading is trading too, okay? So I want us to start thinking about people. Well, I don't have a whole lot of money, and I want to try one of these challenge accounts. And hey, guys, it was a wild week with funded trading, right? Like funded talent and all that stuff. I got burned by it. I had just passed another challenge. Okay, just passed a challenge to where I was going to get a live account, $25,000. They told me to wait until the 29th, and we'll give you further instructions. Okay, I just thought they were backed up. 29th came, they said, hey, we're shutting that program down. Okay. Just because there's one bad actor and one bad apple does not mean the concept of being a funded trader is not good. Okay. So I don't want you all to get jaded about that. We just have to find reputable people. Here's what happened. I plan on doing a video on it. Their model was based upon getting money from people failing challenges. Okay, that if you put 600 up for a challenge, they know that 95% of traders are not successful. So as a result, hey, they did their I think what they call it, the actuary tables. Say, hey, based upon this statistical probability, 95% of traders are not profitable traders. Well, we get these many people taking trades, then they'll pay this and they'll keep taking them. We'll make it, and that'll be a source of revenue. And then we can pay the people who are profitable. We can pay them out of that. And then we can keep the money in the middle. Yeah, but the thing about it is, Traders are becoming more savvy. They're becoming more sophisticated, and they're becoming better. These instruments that we have now, simplicity, my indicator, all of they're becoming more and more accurate. And so it was a house of cards. All funded trading platforms are not built upon that model. Many of them are brokers, and what they will do, the people who are the best traders, they actually copy your trades based on statistics and analytics. They actually copy your trades so they can make money from the trades that you're taking. You know, it's not, but funded talent did not do that. They based it strictly off of the failure of other people. And so that's the reason it kind of found out it wasn't a sustainable model. Okay. So I want I don't want you all to be jaded towards it. That was just a company that tried to come in on the scene, tried to undercut people. They made it easier to qualify. They made it easier to get your money, and people were cashing in on it. And you can't sustain a model like that. Okay. So I don't want y'all to be jaded on that, but I do want us to extract the concept. I do want us to extract the concept of how to mitigate our exposure. Now, we talk about we risk a max of 1%, no more than 3% at risk at one time. Okay. If y'all remember that, give me a 10. Okay. 1% risk, no more than 1% risk on a trade, no more than 3% risk at a time. Okay. So what I want to introduce you all is a concept. Some of you may have seen it before and super easy, or various groups that you've been, but I want to introduce this concept that we can start with a minimum amount of money and exponentially grow that. Okay. Yes, exactly. Okay. And that concept is compounding. Okay. And so I want to show you all a concept of compounding on a very simplistic level. Let me get it up right and ready for you. Give me 1 second, guys. I'm sorry, my apologies. Okay, great. I'm just okay. All right, here we go. All right. Hold on 1 second, guys. I'm trying to find it. Okay, can y'all see that? Y'all can see that? Give me an 11 in chat, please. Okay, great. So this is a compound spreadsheet. Okay. So what it shows is this is the beginning balance that you want to trade from. Okay. So $250, that's the typical count somebody starts with. Okay. And basically what we tell the spreadsheet that I want to have a 5% daily growth. Now you may consider that aggressive or non-aggressive. It's up to you. Okay. But you can change that if you want to change it to 10%. You can, oh no, not 1,250%. That's not realistic. Okay. But y'all see how adaptive it is. Okay. You put 10% growth, but for the sake of conversation, let's just talk 5% growth. Okay. We're not saying that we're not trying to grow the account by 5%. We're trying to exponentially grow our little nest egg that we're starting with by 5%. So this is what we start out with a balance of 250. Okay. At the first level, we're trying to, our profit goal is only $12.50. Okay. This thing is telling us what to do. Okay. Now, how we pursue that 5%, how we pursue that 5% is solely based on our risk tolerance. Okay. What we're shooting for 25 pips. How many of y'all feel comfortable that you can get 25 pips? Given the way that we trade now and the way that we take our trades with tight entry, waiting for optimum entry. Give me a 20 in the chat if you feel comfortable that you could get 25 pips. Okay, just 3 of y'all. Is it more? I'm not doing my job if y'all don't feel comfortable get 25 pips. Okay. So what we're saying is, given how we take entry, that we wait for optimal entry, we wait for everything to line up. I feel comfortable that I can get 25 pips. Okay. So what this is saying is, based with just $250, it's telling you this is the lot size you need to take if you are after 25 pips. TP means 25 pips. Okay. Now this is worst case scenario, guys, because as you can see, we're looking at a stop loss of 20 to 25 pips, meaning that it's around the 1-to-1 kind of neighborhood. Okay. And the reason they have the range 20 to 25 because currency pairs have different values. Some pay $10 a pip, sometimes, some pay $6 and something. So they have a range. Okay. This is worst case scenario because guess what, guys? With the way that we take entries, 1-to-1 should be the worst scenario you should ever get. Okay. We're finding trades where we can get 4-to-1, 3-to-1, 5-to-1. Okay. So I'm talking strictly worst case scenario here. So it's saying, hey, if you're going for 25 pips, well, our recommendation is that you take a 5-cent lot. If you want to go for 40, if you don't feel comfortable with it, want to go for 40, it's 3-cent lot. Want to go for 55, it's 2-cent lot. But all of them will equal up to $12.50. Okay. You reach that level, boom. Okay. Well, now I've got $262.50. So now the next level is my profit target is $13.13. 5 cents again, because it's roughly in the same area. I'm going for 25 pips, 3 cents if I'm going for 40, 2 cents if I'm going for 55. Okay. This ain't like, Tony, this is real boring, it's real slow. But as you can see, it is incrementally going up. Okay. As a result, it's incrementally compounding. Okay. So let's speed it up. If we get down to trade 60, taking the same risk, guys, trade 60, same, what started out as 5 cents, because we now have more capital. We now have $4,235. I now can take an 85-cent lot to go for the same 25 pips. And what started out as $250 is now $4,447. I don't know how much 1,000% growth that is. So if somebody who's good with math can do that. Okay. But guys, as you can see, this is exponential. Okay. And how many setups do we see now? Okay. How many setups do we see now that we can take? And this is the minimum. Okay. This is 5 cents going for 25 pips at least. With this level of stop, we can get higher levels with these 415s and what we just saw with these scalps. We can get way more than 25 pips. But what we need to do is be disciplined to lock in our 25. Everything else happens after that is gravy. Guys, we can cover multiple levels, I believe, in 1 or 2 trades. Okay. If we know we got a runner, if we know we got a 415 that's going to exponentially run, we can cover these levels at chunks at a time. Do y'all see that? That makes sense. Give me a 13 in the chat. how we can cover these at chunks at the time. At the worst case scenario, in 60 trades, 60 positive trades, you should exponentially grow your capital. Okay. And that's just with 250, y'all. Let's just say you got $1,000 in your account. Okay. Now we're going for $50, 20 cents, going for 25 pips. Okay. Look at this. By the time you get down with your $1,000, it has now changed to 17,000. Going for the same 25 pips. If you're not comfortable with 25, go for the 40. But this thing spells out for you what you need to do. Okay. Now, does that make sense? Okay. So let's go a step further. Okay. Let's say we're taking one of these challenges for these funded accounts. Okay. One of them that I looked at today, they give you access to $20,000. Okay. So with $20,000, let's $20,000, the maximum drawdown is like 12%. Okay, so you can lose $2,150 before you fail the challenge, or 5% max within a day. All right. But think of it like this. And I want to challenge you. I was thinking, I know we'd be saying we're trading 1% of the balance. So if we lose 1% trades, then we can fail the challenge, right? Or if we take 10 1% trades and we fail, we can lose the challenge. Right? I know y'all follow me that. But let's do this. Let's do 10% of that 20,000. All right. Now instead of 5%, let's look at 4% growth. Okay. Even though we've got 20,000 in our account, we're trading as if we have 2,000. Do y'all follow me? Give me a 7 if you follow me. Even though we've got 20, we're only trading as if we have 2,000, meaning that I am 90% of my capital. I'm not even including it. Why? Because I'm about to start compounding. So let's look at this. First trade, 32-cent lot, 25 pips, they gave us $80. Okay, that's okay. That's cool. Meaning now with this trading challenge in this one particular company, all we have to do is grow the account by 8%. Well, 8% of $2,000 is $1,600. Okay, 8% of $2,000 is $1,600. Right. Yes. Okay. Of 20,000, it's 1,600. So we just have to grow the account by $1,600. Okay. Look at how it exponentially grows. $80, 83. Now that's will you take a loss here or there? That's fine. But based on this, let's say you get up here and then you lose this trade, provided it hits your stop loss. Well, guess what happens, guys? We only move back to the prior level. So we don't fall all the way back here. We only go back to the prior level. And guess what we do? Well, the prior level was 42. We're gonna get back in at 42, and we're gonna start digging down this trail. Okay. Look at this, guys. Only risking based upon $2,000, not the 20,000. Okay. We got to 3,600 in 15 trades. 15 positive trades. We hit our goal of 8% in 15 trades. And look at this, guys. Look at what we only risked. We risked $80. You could lose $80. You could lose this 80 5 times. Okay, that's $350. But guess what, y'all? We're not tripping off the 2,000, because they are monitoring our ability to trade based off 20,000. Okay. So that's like 1 3/4% that you're down. Okay. It's not like the 1% down or the 2% down. Okay. So what we're able to do, we're able to take small chunks every day as the market presents it to us. And this is the minimum. Again, this is the minimum 1-to-1 standard. We can get much tighter stop losses. We can get better risk to reward ratios by simply doing this. And we, like the old African proverb, how do you eat an elephant? One bite at a time. And look, y'all, we didn't have to do any crazy risk. We were in no risk of blowing our account because we didn't base our risk off 20,000. We based it off 1/10 of that at 2,000. And we slowly built it. And look, we never got higher before we got to 3,600 to pass that level. We never got higher than 55-cent lot size and going for 25 pips. Now, y'all said at the beginning of this, y'all could find 25 pips fairly easily, right? Y'all still with me on that, right? Y'all still feel like, because y'all said y'all can get pips, at least 25, okay? This is the reason we're doing that. Instead of just swinging for the fences all the time, I'm putting 1.5%, and I need to get this, and I don't do it easier, guys. I feel comfortable with what we have started to do and what we started to build. If we can find 25 pips a trade, it can be 25 pips a day. If it was 25 pips a day, there are 20 trading days in a month. 15 right here. Now, will every trade be a winner? No. Nobody's promising 100%. But I believe we can get 70%. I believe we can get 75, 72%. Okay. So when we find markets where it's a good trending environment, we could take multiple entries at this level or at this level, let them run concurrently. And when they hit their 25 pip threshold, at least you may want to cash out, but at the very least, set your stop loss to where it locks in your 25. And guys, we can eat these levels up in chunks. But just look at 2,000, 4% growth, looking at either 25 pips. By the time you get to trade 60, look, guys, 20,000, you have exponentially grown. You have pretty much doubled the account. Because remember, this is a $20,000 account that you're basing your trades off 2,000. There is no need to be greedy. There is no need to push the envelope and try to, maybe need a pair of shoes by Friday and just take crazy risk, because we have totally hedged our ability to put our capital at risk by we have so much padding in there by not trading the full amount that they're giving us to trade. We're trading at 1/10 of it, and then we're incrementally trading it. Okay. Does that make sense, guys? I know it was a lot of this person on third, this person on fourth. I know there'll be a couple moving parts, but I'm gonna put this in the chat in the group so you all can look at it. And this is an Excel spreadsheet, and you can plug the numbers in. Just don't mess with the macro, so it'll change everything around. Okay, I'm gonna drop this in, and then I have another one that I won't share tonight because I don't want to overload you guys. This is pretty much for currency pairs, but there is another one for indices because they move totally different. Okay. Does this make sense? Does anybody need further explanation on this? I know I'm going to post this tonight so you can look at the playback. Okay. Anybody have any questions? Let's raise your hand. There's no dumb question. I just wanted, I didn't want us to just kind of get mundane and doing the same thing. So I want to kind of shake things up and let y'all see that there are multiple ways we can trade this market with the same principle of multi-time frame trading. Any questions? Y'all are either very y'all are either very contemplative tonight or you're totally confused. What session do I suggest for scalping US 30 and NAS? When the New York Stock Exchange opens, not exactly when it opens, it can be very erratic. You have to know what you're doing if you're trading that, okay? But I would suggest go if everybody has a TradingView account, I would suggest you get that. Hold on one second. I can show you, but I can tell you. Give me 1 second. I'm going to pull up. 1 second, guys. Okay, give me 1 second. I'm going to show you guys this. You guys see that? Give me a 4 if you can see that. This is NAS. This is NAS. What you want to do, you want to look at, go to your thing. I think it's a thing called sessions on chart. I don't know if y'all remember me showing it before. Sessions on chart, and you just want to show New York and London. Okay. As you can see right here, and let me pull up the day separators. One second. Session. Session breaks. It's already in. I'm sorry. As you can see, this is the London, New York overlap. As you can see, today it came in at 8 o'clock and it dropped. You can see right here, so where New York and London came in, it hit that bottom and it kept going. So I recommend y'all get a TradingView account just for no other reason than to be able to look at this. This is London. This is when New York and London was together. Okay. And this is great when you guys are choosing what pairs you like to trade or you're thinking about trading. Just pull them up on this is Great British Pound, Japanese yen. As you can see, it has its majority of its movement in London. Majority of movement in London. Okay. And that's green right here. Majority of movement in London. Majority of movement in London and New York. Okay. As you can see, it doesn't move a whole lot right here. Majority movement in London and New York. Okay. And just go through and study. That way, when you're trying to select, hey, I think I want to trade these pairs. This will tell you EuroCAD. Okay, because it uses both of those are open during London and New York. Both of those markets, Euro and Canadian dollar. So they move during those sessions. Okay, great movement. Right. So that's a little peek into that. Anybody else have any other questions? I know I gave you a lot of information tonight, but remember, guys, save your templates. If you change your templates tonight, for a scalp setup that uses the hour, the 30-minute, and the 15-minute, please save it. Save it and rename it something else. Put like Simplicity Scalp, scalping setup, something like that. Okay, that way you can always bring it up. How would I incorporate ADR with these strategies? Okay, so ADR, for those that don't know what it is, ADR is called stands for average daily range. Okay. ADR a lot of times pertains a lot more to day trading because it's average daily range is how much range is left in that day for that pair to move. Yes, I'm going to drop the recording tonight. So it pertains more to day trading. To scalp, for scalping, it's more or less trading to a level. But if you have it on your screen, you have the ADR high and ADR low. Here's one thing: ADR high and low are great profit targets if price is approaching. You can almost guarantee that price will hit if it's within 20 to 15 pip range. You can almost guarantee that price will hit that ADR high. Now it may consolidate after that, or may just shoot up there just to hit it and come down. Okay. So if you're scalping or something like that, that can be a great profit target or something. So you know what? I think it may be strong, but I'm going to take half my position when it hits ADR high or ADR low. Okay. Anybody else? No problem, sir. All right. Well, guys, I won't hold you all any longer. Again, if you have any questions, I think there's still some on here that we have not done a one-on-one yet. Let's get that on and popping. Okay. Guys, watch out for the market this week. Don't really know what it's going to be doing. This is the first week of the fiscal year, so there may be some dynamic moves for them to set the pace. Let's just see what the market wants to do. Okay. You know, don't wish any emotion into any trades, but just take what the market is giving you and let's roll with it. Okay. But I'm going to go ahead and render this. I'm going to upload this video because I know we covered a lot tonight, but please make sure you review it. Skip ahead to the pertinent parts that pertain to you. Okay. All right, guys, have a great night. We'll see y'all next week. And I promise y'all, pertaining to the thing, it is moving along. What I will do, I will drop in the chat what we call a patch. Hold on, let me do this. I'm gonna stop.